Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to forward exchange contract designated as cash flow hedge and redesignated as fair value hedge. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you would like to follow along, and you don't have to follow along in OneNote, but if you would like to, we're going to be in this area down below in the 1140 C3A1, and we are in the Problem Presentations tab. Closing this back up, we're going to go through all the information first. We'll go through it all at one time, and then we'll pull pieces of that information as we work through the practice problem. So we have a forward exchange contract, so we're going to be dealing with. The timeline is going to be, we have the forecasted transaction, so we're forecasting a transaction to happen, not having a contract for it at this point in time, but we're predicting and expecting transaction to take place. So we're doing that on 8/1/X1, forecast the purchase of goods and enter into a 240-day forward contract to hedge the foreign currency purchase. So we haven't made the purchase, we don't have a contract for the purchase, but we predict the purchase to be happening and enter into, therefore, a forward exchange contract, which we're going to make a 240-day contract from this point in time until the end of what we think the cycle of the purchase will be, meaning we actually pay off the payable. Then we have the exposed foreign currency payable component where we have 10/1/X1. That's when we actually receive the goods. So we're going to get the goods on 10/1/X1. And so that means that we're going to actually record the transaction on the books for the inventory that we have received at this point in time. Also note, this will look similar to a prior problem that we have. One of the major changes that will affect our transactions here is the fact that we do not have a contract at this point in time. So we don't have a contract here to make the purchase, but we predict and assume that the purchase will be taking place in the same fashion as we've seen in a prior practice problem. That's going to result in some differences to our accounting. So then on 10/1/X1, we receive the goods. At that point in time, we receive them on account. Therefore, we record the inventory and the related accounts payable that we'll put on the books. We're going to make the payment not in US dollars, however, but in some other currency, that being yen. Then on 12/31/X1, we have a balance sheet date. The balance sheet date we will have to revalue based on the currency exchanges at that point in time. And then on 4/1/X2, we're going to pay the accounts payable in yen with foreign currency units received from the completion of the forward exchange contract. So in other words, this whole thing will come together at the end on 4/1/X2, being another year, the second year of our practice problem, at which point in time we're going to have to pay off the accounts payable. We're going to have to pay it off in yen. The forward exchange contract will become due at that point in time, which will provide us with the yen that we will need to pay off the accounts payable. So let's go through that again, a little bit more detail on this. 8/1/X1, P us, agreement to purchase goods from a Japanese company. So we agreed to purchase the good but don't have a contract. The purchase is forecasted, but there's no binding agreement for this purchase. So that's going to be the major difference than we've seen in a prior practice problem. Then on 10/1/X1, 60 days later, we deliver. The delivery happens, meaning we actually get the inventory at that point in time. So we get the inventory at that point in time, and so then we record the inventory, but we bought it on account. So now we still have an accounts payable on the books. We're going to pay off that accounts payable at the end of the contract on 4/1. We're going to pay it off not in US dollars, but in yen, that being 3 million yen. Then finally on 4/1/X2, 180 days after the delivery payment, so we got the inventory 180 days after we got the inventory, then we're going to have to make the payment. So we're going to make the payment of the accounts payable. We're going to make the payment in yen. So we're going to need yen to do that. 8/1/X1, now we're going to be talking about the other component, that being the forward exchange contract. P, that's us, enters into a 240-day being the 60-day plus the 180-day. The 60-day from the point in time that we think we're going to have a transaction and therefore enter into the forward contract to the point where we receive the inventory, then 180 days from the point we receive the inventory to the point we pay for the inventory. So a forward exchange contract as a designated hedge against the future cash flows from the forecasted transaction. So it's a forecasted transaction, including the foreign currency denominated accounts payable that would result from the purchase. So we got the 3 million yen we'll be dealing with. The future rate for a 240-day forward contract, 0.0073 to 1 yen. We're going to be dealing with the spot rate and the forward exchange rates for the relevant dates on the left. The forward contract designated as a cash flow hedge and redesignated as a fair value hedge. So that's going to be the key. You can think of this as basically kind of two components that we have. We have it designated for that first point up until the point in time that we receive the goods as a cash flow hedge, and then it's going to be redesignated as a fair value hedge, and that's because we have the accounts payable on the books that we're going to be paying in yen in the future at that point in time after we make the purchase of the inventory on account. All right, so first thing that happens is on 8/1, we have the forecast to purchase goods. This is the one we're going to put the forward contract on the books in the same way, but this is where the difference is between some of our other kind of transactions, and that is that it's a forecast and not a contract. Okay, so then we have the foreign currency receivable. We're going to put basically a receivable and a payable on the books. The receivable is going to be a foreign currency receivable from the exchange broker. We're going to be receiving in yen at the end of this contract in 240 days, which we're going to value, and we'll see how to value it shortly, in basically dollars, which is going to be at that $21,900. Then we're going to put the payable on the books, dollars payable to the exchange broker. Notice this is dollars payable to the exchange broker. We're talking about US dollars payable to the exchange broker. This one we're going to value in terms of dollars, and we're not going to change it at the end of until it's going to be paid off. We're going to pay it off in dollars at the end of this thing. So this one will change as foreign currency rates change, because we're going to receive this in foreign currency. This will not change once recorded because it's going to be paid off in dollars. So let's go ahead and do the calculation for it then. We're going to be taking the 3 million yen times, we're going to use the forward rate. Remember that the forward rate is projecting out into the future until the end of the contract and the end of basically the payable, which is when the contract was set to end, because that's when the payable is going to end. So we're predicting, this is like the predictive rate, times the 0.0073. That's going to be the 21,900. So we got the receivable on the books at the 21,900. We're actually going to be receiving at the end of this thing yen, 3 million yen, which we're currently valued at 21,900 using the future exchange rate. Then we have the dollars payable that we're going to put on the books, a liability that we're going to pay after the 240 days. That's just going to be paid in dollars. There's no basically funny business. Once that's on the books, it is what it is. It's just going to sit there. Then we're going to say the next thing that happens is on 10/1. So now we have 10/1, and that means we're going to get the inventory on 10/1. So we're going to revalue this thing as of 10/1, and then we're going to basically receive the inventory on 10/1. So let's revalue the receivable. We're going to revalue the receivable as of this point in time. To do that, let's see where we were last time. I'm going to go up to the last slide and then work the revaluation. So we're going to say we're at the 21.9. That's where we left off. Now we're at 10/1. We're going to revalue this as of 10/1. So I'm going to say the 3 million times the current forward rate. So here's the forward exchange rate as of 10/1, which is 0.0075. So we're going to say times 0.0075. That's going to be the 22.5. So currently on the books 21.9. So 22.5 minus the 21.9 is going to be the $600. That $600 is going to result in a gain. So we're going to have a gain for that $600. Why are we going to have a gain? Well, if we think about it, we're going to say, well, last time we had 1 yen is going to be equal to $0.0073. Now 1 yen is worth $0.0075. Therefore, the yen has gotten more powerful, stronger, get more dollars for more yen. And we're talking about a receivable, which means we're going to get paid in yen. And therefore, we're going to get paid in something that is stronger than it was when we made the original contract. So we have a gain. So we're going to go down and record this out. We're going to say, all right, then the receivable down here is going to be a debit of the $600. The other side is not going to be going to gain as it was in the past. This is the thing that's going to be different. We're going to be putting it into then the other comprehensive income. So we're going to record it in other comprehensive income, recording it in a separate section basically on on the income statement. So other comprehensive income. So now the foreign currency receivable is at the 22.5 once that is recorded, and we have this other comprehensive income on the gain down here at the 600 rather than going into the gain account. Now, if we were to calculate that 22.5, remember that's calculated as the 3 million times the 0.0075 That's going to give us our 22.5, and that 600 can also be calculated. The 600 right here can also be calculated by taking the difference between the rates, 0.0075 minus 0.0073 times the 3 million. 3 million. That'll also give you that $600. So next we're going to put the inventory on the books. So we got the inventory, it's 10-1, we got the inventory, we have then received it. We're going to put it on the books on account. We have not yet paid for it. We're simply going to put it on the books on account. So we're going to debit the inventory just like we normally would in a normal transaction. If there weren't any foreign currency weirdness going on, we would debit the inventory and then we would credit the accounts payable. Same thing here, but the accounts payable we need to indicate isn't going to be paid in dollars. It's going to be paid in yen. We're going to be paying that 3 million yen. That's what we said we were going to pay, but we're going to value the payable in dollars because we need to value it in dollars on our books. How are we going to do that? Well, we'll use the spot rate this time. So now I'm going to scroll down. We got the rates down here again. And this time, even though we haven't paid for it, it's 10-1, we're going to use the spot rate. You might think we should use the forward rate because we're not going to pay for it until April. But I kind of think of it as, you know, we got the inventory today and we're going to value the inventory at the point in time that we got it. So we've got the inventory, so we're valuing it basically as of that point in time, which is the spot rate. So we're going to then take the 3 million times the spot rate, the current exchange rate, 0.007. 0.007, that's going to be the 21. So we're putting the inventory on the books at that 21,000. We're crediting the payable for that 21,000. If we record that, there's the inventory at the 21. There's the payable at the 21. This payable is really going to be paid in 3 million yen. Therefore, it will change as time passes, as the rates change. Okay, let's see what we have next. Scrolling on down, we then note that everything that we've had thus far, these are the transactions we've done thus far. This is the current transactions. Both of those will be included in our current journal entries column on the right-hand side. So now we're going to say it's 12-1. So we're now at the end of the year on 12-1, and we're going to basically say that we need to revalue for the balance sheet date, which is going to be now the balance sheet date. We got to revalue our information for that balance sheet date. So we're going to do the same thing. We're going to be revaluing then the receivable up top. We're also going to be revaluing the payable down here. We're not going to be revaluing the dollar payable to the exchange broker because that's in dollars. So let's go ahead and do this one. We're going to do this 23,100. That's it after we've already recorded our transaction. So let's look at it in the prior slide to see where it was before this change takes place, which is going to be this 22,500. Now we're going to value it in the current time period. So we're going to say, all right, now it's going to be December. So we'll take our 3 million times, and then we're going to use the forward rate for December, which is going to be this 0.0077. So we're going to multiply that times 0.0077. So there's the 21, or the 23.1, and so we have 22.5 in there. So the 23.1 minus the 22.5 is going to give us a $600 difference. Once again, this time it's going to be a gain. So we have a gain there. Why is it a gain? Well, last time it was 1 yen was worth $0.0075. Now 1 yen is worth $0.0077. The yen has gotten stronger, and we're talking about a receivable here, which means we're going to get paid in yen. We're going to get paid in something that has more purchasing power than it did before. That then is a gain to us. So we're going to say, all right, gain makes sense. So we're going to then say the foreign currency receivable is going to be the debit. Then we're going to have the foreign currency transaction gain as the credit. Posting that out, then we've got the receivable has now got that included within it, bringing us to that 23,100, and then the other side being the foreign currency gain now included down here in the gain. Notice the difference here, it now being included in gain, not in the other comprehensive income. We have now passed the point in time where we have received the inventory and are on like the second half or the second component, the second piece of the reason for our forward exchange contract. So then we can just double check and recalculate the liability here, which was the 3 million times the 0.0077. That's going to give us our 23.1. So that's the 23.1 that we have there. And then we can recalculate the $600 by doing it this way. It's useful to know 0.0077 minus 0.0075 times 3 million there. That'll give us our $600 change that way as well. Next transaction, and of course, remembering that all these transactions, including the current one, are going to be included in the entries column here. So we're going to do the same thing for the accounts payable now. So we have the accounts payable on the books. This is after the transaction has taken place. Let's see what it was before, and then make the adjustment for the 12/31 transaction for the accounts payable. Here's the accounts payable. We're going to be paid 3 million, or we're going to be paying 3 million yen in the future, which last time was valued at $21,000, and now we're going to have to adjust that because now it's the end of the year. So we're going to say, all right, we got 3 million yen, and this time we're going to be using the spot rate, which is going to be this 0.008. 0.008 times 0.008 is going to be 24,000. So 24,000 minus what's currently in there, 21,000 minus the 21,000. That's going to give us a $3,000 difference, that being a loss. Why is it a loss? Because, well, we would expect it kind of to be a loss because this was a gain on the last transaction, and this is going, this is a payable and that's a receivable in the same currency. So it should be the opposite. That's kind of why we set the thing up. But also, we know that last time we had 1 yen is $1.007. Now 1 yen is worth $0.008. Yen has now gotten stronger. It's worth more dollars. And now we're talking about a payable, which means we're going to be paying in yen, which is now something that's worth more. So that means that that's a loss to us. So that's not good for us. Okay, so then we're going to say the foreign currency transaction loss will then be the debit. Once again, note that it's going into the loss account, not into the other comprehensive income account. And then the accounts payable will be the credit. So the accounts payable then up top at the 24,000 after this has taken place, after that transaction is included, the then loss of the 3,000 down below. Once again, if we calculate that 24,000, I'm going to go down here to do so this time. It's going to be the 3 million times the 0.008. So there's the 24,000, there's the 24,000, and you can recalculate that 300. It's useful to note by taking the difference between the two rates, 0.008 minus 0.007 times the 3 million. And that'll give us the $3,000 difference. Okay, so then going down, now we're going to be at 4-1. We're going to be in the next year. This is when everything is, this is the point we've been waiting for. We've been looking forward to this like the whole time. So now it's 4-1, and that's going to be when we actually pay off the payable, and the forward contract is going to be ending at that point in time. So before we get into that, we want to note that the ending balances in the end of year 1 here will now be the beginning balances in our trial balance here for year 2. Note that the equity section is including all of the equity up top, the $100, and all of the activity on the income statement now included in the equity section at that $98,200. So we have basically a post-closing trial balance or a beginning balance, trial balance, that we're going to be recording into temporary accounts having nothing in them up until this point. So now it's 4-1x2. We're going to close this thing out, but before we do, we got to revalue everything to that point. So we're going to be revaluing once again the foreign currency receivable account, the accounts payable account, but not this one. So we got to do those two. So we're going to say, all right, let's see where we were before, which this time we could just see here because this is where it was last year. And so we're going to say it was at 23,100, and now it's 4-1. So we're going to say now it should be 3 million times. And now we were using the forward exchange rate, but we're not using that anymore because that was predicting out into the future. And we were always predicting out to this one special day, which is now here, which is April 1st. So now we're in the present, therefore no forward exchange rate, but only the current rate, the exchange rate, the spot rate. So 3 million times the 0.0076, that's going to be the 22.8. What's currently in there, the 23.1. So the 22.8 minus the 23.1 is going to give us a difference of $300. That $300 is going to be a loss. Why is it a loss? Because last time we were using this rate, and that was 1 yen was worth $0.0077, and now 1 yen's worth $0.0076. The yen has gotten weaker. And this is a receivable, so we're going to get paid in yen, which is now worth less than it was before. So that's not good for us because we're going to get paid in that thing that's worth less now. So that's going to be a loss. So we got the foreign currency loss is going to be the debit. Other side going to the foreign currency receivable from the exchange broker. Important to note that we're recording this in the loss account, not into the other comprehensive income, because we're on the second component of this. Where basically it's kind of hedging the accounts payable now, right? And so now we have the foreign currency receivable from the exchange broker, and that's going to be up here. Ending result being that 22.8, which once again is calculated as 3 million times the 0.0076, which is going to be that 22.8 here. So remember, that means that that's what we expect to get in terms of US dollars. What we actually get is 3 million yen. So we're going to receive 3 million yen, which we've now recorded as the 22.8 in terms of the dollar equivalent. Now we're going to do the same thing for the payable. So if we go down to the payable, we're going to say, all right, the payable before was this 24,000. We had 24,000 in the payable. Remember that everything from the prior, the prior transaction and the current transaction are included in the current entries section. So now we have the payable of the 24,000. We have to revalue that for the current date. We're actually going to get to the same calculation this time because remember, everything's coming together right now. We're in the present. The forward exchange rates are now what they are. They are the same rate as the spot rate at this point in time. And we've been using the spot rate the whole time for the accounts payable. So now we're going to say the 3 million times the 0.0076 is going to be that 22.8 again. We have 24,000 in there. So the 22.8 minus the 24,000 is going to give us a difference of 1,200. That's going to result in a gain. Why does it result in a gain? Well, one, it's the opposite of the loss up top, which we would expect it going into the opposite direction given the fact that this forward contract was a hedge against the accounts payable thing. So that would make sense. And also, last time we were using 1 yen was worth $0.008, and now 1 yen is worth $0.0076. So the yen has gotten weaker, and we're talking now about a payable that we're going to pay in yen, and the yen has gotten weaker, so we're paying in something that has less value than it did before. So that's going to be a gain to us. So it's good. We're giving up something that's not as valuable as it was. Okay, so then the accounts payable is going to be debited by the 1,200. We're going to be crediting the foreign currency gain then. So the accounts payable now at that 22.8. The foreign currency gain is now recorded on the income statement. Note, once again, it's in the gain account, not into the other comprehensive income account. That 22.8, once again, calculated as the 3 million times the 0.0076. That's what's recorded here, the 22.8. We now have the accounts payable at that amount. We're actually going to pay 3 million yen, which is currently valued at the point that we're going to pay it at $22,800. Also note that we can calculate this 1,200 transaction here by taking the difference in the rates, 0.008 minus 0.0076 times the 3 million. That'll give us our 1,200. So there's the 1,200 once again. All right, so then we're going to go down and say that we're going to pay cash and we're going to pay off the dollars payable to the exchange broker. That's going to be this item, the dollars payable to the exchange broker. It hasn't changed. This thing has not changed since we put it on the books. It's in dollars. We're simply going to pay it off. So you'll recall, just to recall this thing, back on 8/1, we put this thing on the books for the forward exchange contract. It was the 3 million times the forward rate at that point in time, 8/1, like the first thing we did, times 0.0073. And we put it on the books at the 21,900. And we just said as part of the forward exchange contract, we're just going to pay that at the end in dollars. There's no foreign currency. There's no foreign currency adjustment. There's nothing funny happening. We just said we're going to pay that back as part of our contract in 240 days. So we're going to pay it as part of the contract in 240 days. Now it's 240 days later, and we're simply going to pay it. So from a transaction standpoint, straightforward. We're going to say then that the cash is going to go down because that's what we're going to pay it with, to US dollars. Then we're going to debit the dollars payable to the exchange broker. That means the dollars payable to the exchange broker goes down to 0. Cash then goes down for the 21,900 that we are paying. Now we're going to have the second half of the forward exchange contract where we're going to receive the units that we were promised to be received at this point in time. So let's go back up to the prior slide to take a look at where we are before this transaction. We're going to say, all right, the second component is that we have this receivable on the books, which we have now revalued to the 22,800. That receivable is for 3 million yen, which we currently valued at the $22,800, and the exchange broker is going to pay us the 3 million yen, which means we're going to reduce this receivable that's recorded in dollar terms of the 22.8, put the yen on the books, which is going to be actually 3 million yen, but we're going to put it on the books at the value, of course, of the exchange rate up that 22.8, measuring the yen in terms of dollars. So we're going to then say that we have the foreign currency units, 22,800, that we're valuing what we got, just like if we got stock or something like that, or some other units of inventory or something, we would value them in dollars. So we're going to value them in dollars. The other side bringing the receivable down. So we're going to say, all right, so now they gave us the yen, so the foreign currency receivable has now been going down, so it's included in this number. It's now at 0 after this transaction takes place. The foreign currency units then on the books now at that 22.8. Once again, of course, that 22.8 is the valuation of the current spot rate times the 3 million yen that we actually got. So now we have 3 million yen, which we valued on our books at 22,800 at this point in time. And we have a payable that we now owe to the Japanese company, which we bought the inventory from, of the $3 million. We owe $3 million indicated by this item here, which we have valued in the current point in time, once again, using the current spot rate at the 22.8. So now we can pay off the 3 million yen that we're holding on to, reflected by the current cash US dollar value, the 22.8, to the Japanese company, which will then pay off and then record the liability being reduced of the 22.8 on the liability side. So let's go ahead and do that. Everything, all the transactions up until and including this transaction is included in the entries column. We will then just simply reduce the accounts payable by the 22.8 and then reduce the foreign currency that we're going to use to pay it by the 22.8. That brings the foreign currency down to 0 here, and then the payable now goes down to 0 as well. So that's going to pay that off. Once again, the 22.8 calculated as the 3 million times the current spot rate, the 0.0076, which we had revalued the payable and the foreign currency to be right before the transaction. This all taking place, of course, at that same point in time, April 1st, 2000X2. So at this point in time, we have the cash at the 78,100. We've got the foreign currency in units have now gone back down to 0 because we received those units, the 3 million yen, from the exchange, forward exchange and the broker, and then we used it to pay off the accounts payable that we promised to pay in yen. Then we have the foreign currency receivable from the exchange broker has now gone back to 0 because we have received the 3 million yen, which we put on the books when we first recorded that item. The inventory is now on the books at the 21,000. This is where the funny thing is here, the new kind of thing, the change. Notice that 21,000 is simply what we put it on the books for at the current spot rate when we got the inventory. So we got the inventory on 10/1, we took the 3 million, we multiplied it times the 0.007, we put it, we put it on the books at the 21,000 at that point. We didn't touch it again. It hasn't been touched since that point. However, we did include in the other comprehensive income transactions in differences to the exchange rate up until we actually got the inventory. And then that would roll into basically other comprehensive income, which we're going to say is included in the equity section. So that did not change up here, but that was a little bit different, and it's still going to come into play when we actually sell the inventory. So although the inventory wasn't affected here when we sell it, we're going to have to deal with that other comprehensive income with regards to the cost of goods sold. So that's going to be kind of like the difference transactions that happened. The accounts payable has now been paid off, so we paid off the accounts payable. The dollars payable to the exchange broker has now been paid off. We paid them off in dollars. Nothing happened with the firm commitment here. Notice that's one of the different components to the prior problem, which was similar to this, where we had a contract. Instead, the items before, from the point in time that we have the contract, but before we actually made the purchase of the inventory, the change in the exchange was going into the other comprehensive income, which then flowed into, we're going to say, equity included in the equity accounts here. So then we have the equity, which is, it has changed by the changes in the, from 100,000 where it started, by the changes in year one, changes to the income statement, as well as the other comprehensive income. We're just going to say are included in total equity here. And then we have the the adjustments in the current year, all going to gains and losses, because in the second year, we're only talking about that second half of why we had the forward exchange contract. So we didn't record anything to other comprehensive income, but put them all into simply the gains and losses. Now, let's go one step further and just assume that we sold this inventory. Now, when we sell the inventory, we're not going to record the sales side of things, which is, debiting cash or receivable and then crediting the sales. What we want to do is think about what's going to happen with the inventory and then specifically the cost of goods sold in this other comprehensive income accounts, because that's the thing that'll be different. So we're going to say, all right, now let's assume that we sold the inventory. Again, we have the sales side. We're looking at the cost of goods sold side, which normally is a debit to cost of goods sold and a credit to the inventory. So you would expect it to look like this. We would have part of it look like this, right? We would say the cost of goods sold would be debited for $21,000 as part of the sale, and then the inventory would go down, which would bring the inventory down to zero, and that would be included in cost of goods sold. However, we also have that component that we included in other comprehensive income in year one, from the time period that we had the forward contract until the point in time that we bought the inventory, which we basically put in other comprehensive income instead of capitalizing it in the income, in the inventory account, in the asset account, which we're now going to include in the calculation of the cost of goods sold. So we're going to then credit the other comprehensive income, which I'm just going to simply put into equity because it was in year one, other comprehensive income. I'm just going to say we grouped it all up into equity. So we're going to put it into the equity, and then the cost of goods sold is going to be affected at that point in time. So what's the effect on this? If we use this, when we're using this method, because we didn't have a contract, and that's when we use it, we're going to say that the other comprehensive income is going to be affected. There's no effect to the inventory for the entire time period. However, once we make the sale of the inventory, there is going to be an effect on the cost of goods sold account at that point in time. So that's where one of the changes will be.